Welcome back to the Wall Street Podcast. Today we're taking a deep dive into Citi Research's latest oil monitor report. This one's titled Resilient Prices for Now, and it just came out August 27th, 2025.
That's right. And our mission today is really to unpack why oil prices are holding up, despite what looks like an incoming oversupply. We'll be looking closely at geopolitics, supply issues, and especially those critical inventory levels for things like diesel.
Exactly. So let's start with those geopolitical and supply dynamics. The report points to Russia-related issues, tariffs, sanctions, infrastructure hits.
Yeah, those are actively cutting crude exports by about, 0.3 million barrels per day. And it's hitting their refining capacity, too.
So that's a direct supply constraint right there.
And it's not just Russia. We're also seeing OPEC plus production coming back online slower than expected.
Right. And then there's India. The report estimates they're diversifying away from Russian oil, maybe cutting purchases by 0.2 to 0.4 million barrels a day.
Which, in turn, prompted those U.S. tariffs 50% on certain Indian goods. That creates, well, significant trade friction linked directly back to oil flows.
Okay, let's shift to market indicators. Brent prices are pretty resilient, holding in the high $60, or around $67.08 right now.
Yeah, holding steady. But what's really interesting is the Brent-Dubai spread. It's tightened up quite a bit.
And what does that tightening tell us?
Well, it signals a stronger market pull for medium crude. Dubai crude, which is medium and sour, is being valued much closer to the lighter Brent. The market wants those medium barrels.
Okay, and what about backwardation? The report mentions gas oil margins.
Right. The backwardation in Brent refining margins for gas oil is much steeper than for Brent crude futures themselves. So backwardation means near-term prices are higher than future prices. Steep backwardation like this points to really urgent, immediate demand for gas oil.
Driven by inventory concerns.
Exactly. Deep concern over low gas oil stocks. And meanwhile, China's still importing strongly, building up their own crude inventories.
Which brings us squarely to inventories in the forecast. Global stocks for gas oil, diesel, heating oil, middle distillates are critically low.
Critically low is the term they use. Europe's ARA region, that's Amsterdam, Rotterdam, Antwerp inventories there are roughly 13% below last year.
And the U.S. picture?
It's similar. Commercial crude, gasoline, and low-sulfur diesel stocks are all down compared to last year and the recent 5-year average. U.S. low-sulfur diesel specifically dropped 1.8 million barrels just last week. It's now 22.4 million barrels below its 5-year average. That's a big hole.
Wow. So given all that, what's Citi's price outlook?
They're forecasting Brent at $66 a barrel for this quarter, Q3 2025, then easing a bit to $63 for Q4 as that expected oversupply perhaps starts to weigh more heavily.
Okay, let's dig a bit deeper now with some specific questions. First, thinking about those U.S. tariffs on India and the tax on Russian facilities, what's their combined impact on price resilience, maybe beyond just the barrel counts?
Well, it's more than just the sum of the barrels. The U.S. tariffs tied directly to India's Russian oil buys, plus that's a 0.3 million barrel per day hit to Russian exports from damage. Together, they create significant market friction. It introduces a layer of uncertainty, logistical headaches. It's not just about volume removed, it's about the disruption and risk perception, which actively supports prices.
Okay, that makes sense.
Now let's decode those market signals further. The tight Brent-Dubai spread and that steep gas oil backwardation. What are they really telling us about underlying demand as winter approaches?
They're basically shouting that there is strong, immediate demand for medium crude streams. Why? Because refiners are desperately trying to maximize diesel and heating oil output due to those critically low inventories we just talked about. Medium and heavier crudes give a better yield of those products, so refiners are chasing those barrels. It also suggests, perhaps, that India's move away from Russian oil might actually be bigger or having more complex flow impacts than the headline numbers show.
Like a bottleneck indicator. Exactly. A bottleneck for producing enough middle distillates globally.
So final question here. With winter coming, just how critical are these low middle distillate and diesel inventory levels for stability in prices?
Extremely critical. You've got U.S. diesel stocks, 22.4 million barrels below the norm. Europe down 13% year on year. That's a major global deficit. Add in ongoing Russian refinery issues, plus the constant threat of, say, a hurricane hitting the U.S. Gulf Coast refining hub. It creates a real vulnerability. This deficit provides very strong underlying support for prices right through the winter season. It's a clear risk to supply stability.
All right. So pulling this all together, what's the bottom line for you, our listener? Well, these findings aren't just abstract market dynamics. They hit home. Resilient crude prices, plus those critically low diesel and heating oil stocks. That likely means higher prices at the pump.
Yes, for both gasoline and diesel. That feeds into transportation costs, logistics costs for businesses. Everything gets more expensive to move. And, of course, potentially higher household heating bills as the weather turns colder. It really shows how interconnected things are.
These geopolitical events, supply chain issues, even things happening far away, they directly shape your budget and the wider economy.
It's a powerful reminder of that interconnectedness and, well, the real cost it can have.